Hi, I'm Bob Kolb, Professor of Finance here at Loyola University, where I also hold the Frank W. Considine Chair of Applied Ethics. And joining me today is Joe Rizzi, Senior Investment Advisor at CapGen. Joe, thank you very much for joining me.
Thanks for having me, Bob.
Joe has held a number of positions in finance. He was most recently Managing Director for Enterprise Risk Management at LaSalle Bank Corporation, and before that he worked abroad at ABN AMRO. So Joe is really an acknowledged expert in the world of risk and an expert on the credit crisis. Joe's educational background includes a bachelor's degree from DePaul University, an MBA from the University of Chicago, and a law degree from the University of Notre Dame. So Joe and I discussed prior to today that there's so much involved in the credit crisis that we needed to narrow our focus just a little bit. So we agreed that we'll focus on collateralized debt obligations, or CDOs, as an example instrument, and then talk about the credit crisis with respect to that. So we further agree that we just talk about what are called cash flow CDOs, one of the main types, perhaps one of the easier types to understand. So with that background, Joe, could you perhaps just start in and tell us what is a CDO?
Sure, Bob, and again, thanks for having me here. The way I like to look at a CDO is basically, it's like a mini bank that goes out and buys a pool of financial assets. The financial assets are secured by claims on those financial assets in the form of securities, and they can be tranched. And when they're tranched, what I mean by that, and sorry for the buzzword there, but basically what I'm getting at there is that they have different degrees of claims on the cash flows and the assets. And they can get quite complicated sometimes. You can have tranches that can be in 30 to 40 different tranches, and they allocate out credit risk, interest rate risk, and prepayment risk.
Right. So generally these financial assets that are underlying the CDO are mostly debt instruments, but I suppose they don't have to be.
Correct.
And then the tranches are divisions of claims on that pool of assets. So people who own a title to a tranche don't really own the underlying assets exactly, but they own the cash flows that those assets throw off.
They own a claim that's a partial interest in the assets. And that's really one of the benefits to CDOs originally, is that by having this ability to tranche the securities, it's almost like you're creating a customized security. So that if you were a pension fund and you were to come to me and say, Joe, I need a 5-year instrument that's rated single A, that basically has no early prepayment features attached to it, I can come up with something for you.
Right, so that they take this pool of asset and divide it into tranches with all these different kinds of characteristics.
Correct.
That differ with respect to seniority among all the tranche holders, that differ with respect to the rating and so on.
And the cash flows.
And the cash flows.
Right.
So really they slice and dice the claims on the underlying assets.
Correct.
And that gives rise to another colorful term in CDOs, a waterfall. And maybe you can explain that.
Sure. Well, being Italian, sometimes I need to speak with my hands, but basically the waterfall is nothing more than looking at your cash flows, and as they start to cascade down from the highest point in terms of priority and seniority to the lowest point. So if you start off with $100 worth of cash flow, let's say in the form of interest payments, the top tier will get a claim to 90, and the bottom tier will get the $10 that's left over. Now, obviously, what that means is if the cash flow is short, let's say you only have $90 worth of cash flow, the only people who get paid are the top tier holders.
Right, and down at the bottom, the equity holders get what's left over.
Correct.
And then there's a scale of ratings that go with those different claims, where the senior most have perhaps a AAA rating, right, down to a very low or no rating for the equity holders.
That's correct.
Right. So who creates these?
Well, they originally started off going back to Drexel Burnham back in the 80s. And you know, one of the advantages of being at advanced age like myself, I'm able to remember those types of characters. And what they were put up for is basically to take non-investment grade companies and allow them to take their assets, pool them, and get an investment grade rating to get a lower cost of funding and to diversify their funding base. So if you can remember, Chrysler Financial at one time was, and still is right now at this day, was a very weak company. But they were able to go out and raise investment grade debt by pooling the auto loans together.
Well, perhaps this is a naive question, but maybe it's a naive question people should have been asking all along. You said they pool these assets together and they can get a credit enhancement, but it's still the same crummy assets that were in the pool beforehand. So how does this credit enhancement work?
That's an excellent point. It has to do with the assets themselves. And by that I mean the following. If you have auto loans and you have a predictable history or experience level, and you know that over a period of the last 30 or 40 years, no more than, let's say, 1 or 2% will go bad within a year's time. If I want to get a AAA rating, I go to the rating agencies and I determine what multiple of that loss coverage I need. So if it's 2%, and they tell me I need a 5 times coverage to get a AAA, if I have a 10% over collateralization, which you can look at nothing more than equity, it's a fancy word for equity,
right,
then I'm covered.
Right.
Okay. Any residual returns, or if the loss experience is better, goes to the equity holder.
Okay. So what about the underwriting process and the creating process? Who's involved in that, and how does that work, basically?
That's an excellent question, because there are a number of parties, all with different interests, that are involved in a CDO or securitization transaction. You have the underlying debtor, the auto loan purchaser, you and me going to our Chrysler dealership to buy a car. You have the originator, which is the Chrysler dealership. You have the structuring agent, which could be a JP Morgan Chase or a Goldman. They structure and then they underwrite the transaction. You have the rating agencies, which have somewhat acted like a financial Supreme Court. Then what you have is you have the lawyers, accountants, collateral agents, and then at the bottom of the food chain is the investor.
Why is the investor at the bottom of the food chain?
Because it's not good to be at the bottom of the food chain. Well, sometimes I'm being a little facetious, but what happens is that these were sold under the premise that with a securitized transaction or a CDO transaction for a AAA rated security, you could pick up an incremental yield.
Okay. Well, that kind of brings us into questions of the market for these. So far we've seen that they're fairly complicated, that the tranches are slices of claims on the underlying pool of assets. But how can these trade? Once you've got one, do you have it for the duration, or can you trade them, and how does that work?
Theoretically you can, but they're not meant to be traded. And if they are traded, they are not traded the traditional way. Ordinarily, when you would trade something, you'd have a full understanding of the risk characteristics and the return characteristics. The only way you can get that with these instruments, where you have documents that are this thick, is you have to sit there and read each one. They're customized transactions. That's the whole purpose, is that they were built for a customized need. So you could theoretically trade small pieces, 10 million, 15 million at a crack. Anything over and above that, you trade by appointment, which means they're inherently illiquid.
That's the first mention of the word liquid, which really kind of naturally leads us into talking about some of the events that have been so much in the news recently.
Right.
So these instruments are complicated slices and dices that maybe are not so liquid. And then how does that lack of liquidity tie into the evolving credit crisis?
Sure. Well, basically what happens is that you need to have a way to value these instruments which are on your balance sheet if you're a financial institution or an investor. And liquidity, if you can get a market price, provides the best standard for valuing that instrument. What ends up happening with these transactions is you end up valuing them based upon a model. The model has various inputs. The inputs and the models themselves are disparate. there's really no way to compare your model with my model. And also the inputs and the assumptions that you're using are going to be different. So during the growth phase, when everything was working out well, the underlying market liquidity, not necessarily for these instruments, but just the market liquidity in general, was allowing these instruments to trade up to their model price. What happened starting last year around this time is that events began to occur. You had the Bear Stearns situation, you had the Hong Kong Shanghai Bank Corp revaluing their home equity loans and also their home mortgages. And at that point in time, people started to lose faith in the models. And when you lose faith in the models, the normal reaction is that the bid-offer spreads widen dramatically. And when that happens, the liquidity shuts down. And as the crisis got worse and worse, it almost fed upon itself. The models you would lose faith in. The bid-offer spreads would widen. Liquidity would fall. You would try and sell an instrument to get a price, and it was almost like a prisoner's dilemma situation. The first one out got the best price. And the people that were later in line, the price kept dropping. And as the price kept dropping, the market losses kept rising.
Right. Well, what I hear you saying is that we have two concepts about valuing these, mark-to-market and mark-to-model.
Right.
And that in, say, a liquid market for a stock that trades a lot, like, say, Apple, one can observe market prices on a more or less continuous basis. And one can have confidence that you can actually sell your Apple stock for 140 or whatever that price is. Right. But with these instruments, there's no current market price because, as you already explained, they don't trade frequently.
That's correct.
And so people use relatively high-tech finance to try and figure out what these are worth. And so they mark them to a model.
Yes.
The models, however, are not comparable one with another.
That's correct.
And that disparity, of course, then doesn't instill much confidence in the valuation. Right. So then, again, following along on what you were saying and sort of making sure I've got it, when you go to sell it, well, can you sell it at the model price? Well, perhaps you could at one point, but once people start to have doubts about this, no, you find out you can't. So you sell it at a lesser price. That establishes a market price observation. Everyone pays attention to that, and they mark things down.
Correct.
And then let's talk about that spiral in more detail,
sure,
where you go from marking to model to marking to a new lower market price. The model's prices are adjusted, and then where are we?
And two things start to happen. One is you have basically a margin or collateral call, which begins to occur because most of these instruments have been financed based upon leverage. The most typical one is for the dealer community like Bear Stearns, is they use what's known as the overnight repo market. And it's basically a form of secured loan. Now you need to have a cushion in that repo instrument so that the lender has some degree of confidence that if the market price were to drop, he won't get wiped out. As that market price starts to drop, the cushion starts to rise dramatically. Whereas maybe at one time during the high point of the market, you were having, let's say, a 90% advance. As you got through the summer of last year and into now, you're seeing that the cushion is widened to greater than 50%. That has a tremendous deleveraging and, I don't know if it's a proper English word, but deliquefying effect upon the market. You're just sucking out the liquidity.
Right, because as people have less and less confidence in these, they want to see more and more cash.
That's right.
But if you're already in a highly leveraged position, you don't have a lot of spare cash hanging around, and suddenly find yourself in need of that.
You make an excellent point, Bob, on the distinction between liquidity and marketability. Cash and government securities are liquid. Collateralized debt obligations and securities in general are marketable at certain points in time. And marketability is a perception in the investor base. As they start to become concerned, if you use a behavioral finance term, or if you use a street term like I would use, spooked, what will end up happening is that marketability can dry up in a moment's notice.
Right, so people find themselves holding these illiquid assets, but needing to come up with liquidity for these margin calls and enhancement, But that drives them to sell these instruments in the market.
That's right.
But then what happens?
The prices spiral down, which triggers a further liquidation or margin call, and it becomes a vicious circle.
Right. I think we saw something very similar to this in the late 90s with long-term capital management and the liquidation
Absolutely.
of their portfolio, where the urgent need to sell means that the price that you're going to get for it is not at all the price that you thought you could get for it not too long ago.
That's an excellent point, because if long-term capital management had been able to hold on, the position subsequently came back where they would have made a profit.
Right. Well, I suppose we don't get too much into that, but I think in that situation, lots of people in the market realized what a long-term capital was holding, and they were reluctant to trade with them on favorable terms because they anticipated that they could soon get better terms.
Correct. And it's another excellent point, because as much as people like to say they don't know where the risk is being held, within the dealer community, they know where the risk is being held. And when Bear Stearns started to experience problems, that's exactly what happened. People knew who had it. They knew how much they had. They knew what type of instrument they had. And it's the old story, I'll just wait.
Right. Well, I suppose it's fair to say that today we know we're somewhere in the evolution of this credit crisis. We don't know whether we're at the end, the beginning, or somewhere in the middle. I think no one knows that. If I knew that, I would be in very good shape, I suppose. But in the present circumstances, here we are sort of in the middle of things. What can be done to enhance the liquidity of these instruments at this point?
Now, I think a few things. The first is the well-known transparency issue. You need to be able to have people get faith back in their models. In the past, what they have done is either used a complicated model, or they had externally delegated the valuation to a rating agency. And the rating agencies, they are populated by human beings just like you and me, and they make mistakes. And in addition, they also have certain inherent conflicts that are going on, which make them want to be more accommodative to the product. So you need models which make sense. You need models which are developed internally. You have to stop delegating out the credit process. You need also to start to move to more what I would call exchange-traded instruments rather than the over-the-counter instruments. The over-the-counter instruments are, by their very nature, illiquid. They're not standardized. If you move to an exchange-traded instrument, you get the transparency. Now, from the dealer community, the only problem with that is that when you get transparency, profit margins narrow.
Right.
So they've been fighting that tooth and nail.
It becomes more of a commodity, like
Absolutely.
a futures contract or an exchange-traded option.
The other thing which is happening, Bob, is that you're seeing simpler structures. By that I mean you're seeing the European technique called a covered bond coming into place. All a covered bond is that you take a pool of mortgages and you sell them to the public. However, the bank that is securitizing those mortgages provides a backup guarantee. So at the end of the day, you know you have two claims, basically. You have a claim against the assets, a secured loan, and you have a residual claim against the bank. That also puts the interest of the bank as the originator and underwriter together with the investor.
I see. So, because they have to stand behind the whole deal, if you will. Well, you touched a little bit about some market structural changes that you think might be good, moving to an exchange-traded type of instrument. But what about regulation? I think these days, especially, there's suddenly talk about revamping the regulation of all these instruments as well as all financial institutions.
The problem with regulation is that you end up substituting a perceived market failure for a regulatory failure. You just have to think about it logically. If the market paying what some people characterize as overinflated wages and bonuses to people to figure this out couldn't get it right, it's highly unlikely that the regulators are going to get it right.
I see. Well, one theme we hear a lot in the news these days is a lack of sophistication on the part of the regulators, and that they're I've heard the phrase overmatched by these more sophisticated financial types that you're talking about.
Well, that's, I think, is part of the problem, but I think also the regulators had fallen prey to falling in love with their models. You know, as you know, the last few years, the whole movement on the regulatory front, the BIS 1 and 2 features have been moving down to the quantification and the modeling of risk. And they really believed that these products were dispersing the risk and making the system safer. Therefore, the systematic risk for the economy was coming down. I think where the error came into place is that the risk never really disappears. If you have toxic waste, no matter how you carve it up into small pieces, it's still toxic waste.
Right. Well, that phrase toxic waste has a certain meaning or usage in this context. Maybe you could explain that a little bit.
Traditionally, what toxic waste had meant was the bottom pieces of the CDOs, or the residual claimants, who took all of the risk. So going back to our Chrysler example, if you had a 2% loss experience with a particular auto loan asset class, they were the ones that were basically taking that risk. So the first 2% that would go bad would be borne by them.
Right. So toxic waste is sort of, in an earlier and happier time, an uncharitable description, because no one really thought it would be toxic waste, or not the toxic waste it's turned into, I suppose.
That's correct.
And in fact, a lot of things were not regarded as toxic waste, farther up the waterfall, if you will, have turned out to be pretty toxic themselves.
Yes, that's true. The super seniors, as they're called, which is the top of the food chain, they've ended up suffering mark-to-market losses of greater than 50%.
And that's the highest tranche.
Correct.
So that's an enormous and probably completely unanticipated development.
It was completely unanticipated. Now, what's also interesting about that is that it's as if the originating banks had started to drink their own Kool-Aid because they were the ones holding a majority of this. You know, you've seen the massive write-offs at Merrill Lynch, Citi, and UBS. And they had held this for two reasons. One is that they felt that they were getting a credit arbitrage because they were getting an excess return for a AAA security. So let's say normal AAAs would be getting 25 basis points in the marketplace. They'd be picking up an extra 50 basis points.
So like 25 basis points above LIBOR, say, or something like that.
Above LIBOR, or if you want to go above treasuries on a swapped out basis, however you want to do it.
Right.
But as my boss once instructed me, is that if it's trading in excess to normal AAAs, a logical question to ask is it really a AAA?
Absolutely. Right. Otherwise, that's a gift from the market to you.
That's right.
Right. Yeah, I think one of the most stunning things about this whole crisis is how many of the most sophisticated institutions in the whole world of finance have been taking enormous write-downs in the multi-billion dollars. Right. And so no better proof of their ignorance of their own models and their own valuations could really be asked for, it seems to me.
That's part of it, but I have also another theory. Whether it's right or wrong, I don't know. And that is, it's one of incentives. And if you look at the way most of the senior management at these institutions are paid, it's basically a bonus, and sometimes they get some stock incentives and things along those lines. But really, even if they're getting stock incentives, as we know from the option pricing model, one way to make those options more valuable is to increase the volatility of the earnings of the organization. And when you're getting an annual bonus and you have risk in the tails, which is duration of 2-3 years down the line, it almost pays to roll the dice.
Right. You're thinking here more of the financial types who actually work with these rather than senior management, or
both.
Senior management as well? Senior
management as well. When you look at someone who was running a Merrill Lynch or something like this, who was able to earn for the last 3 or 4 years hundreds of millions of dollars of incentive compensation, and then is subsequently fired when the bank blows up, he does not have to give back those hundreds of millions of dollars.
Right. Well, maybe not. A lot of the suits that are sure to come from this whole escapade have yet to be filed, and the whole event certainly will take a long time to play out. And I hate to put you on the spot as a prognosticator here, but how do you see this crisis eventually resolving and playing out?
Not to be flippant, it will end.
With a bang or a whimper, do you think?
Most likely the way it'll play out is that it'll work its way through the system. There'll be some more bangs in terms of some major financial institutions in the US and in Europe having significant problems. But basically it will play out. You just need to work the leverage out of the system that has occurred over the last 3 or 4 years.
Well, I think maybe on that optimistic note, we can draw our conversation to a conclusion. Certainly, I think nobody really knows how this will end, and nobody knows where we are in the process, but it has certainly concentrated the minds of those of us in finance. It is certainly an interesting time to be in finance, and that reminds me of the Chinese curse that may you live in interesting times. So again, Joe, thank you very much for joining us, and thank you for sharing your wisdom with us.
Thanks, Bob.